Hello, everybody. It's with a great pleasure I welcome you all to this outreach event this Monday morning. This event is hosted by the Norwegian Accounting Standards Board, the Norwegian Society of Financial Analysts, EFRAG, and the IASB. So welcome, everybody. We have a very competent speakers today in the panel, and I expect that we all will learn something new. My name is Bjørn Einar Strandberg, and I'm currently chair of the technical committee of the Norwegian Accounting Standards Board. We have now more than 150 registered participants today, so that's a great thing. And maybe the coronavirus has indeed lowered the threshold for participating in such events, so something good comes out of this as well. The background for today's seminar is the discussion paper issued by the IASB in March of this year in response to the post-implementation review of the accounting standards IFRS 3 for business combinations. And among other things, the users of financial information have firstly asked for more information following business acquisitions and mergers. And secondly, there's also the question of how to account for goodwill in the future. So in this webinar, some of the key proposals will be presented by IASB's Tom Scott and Tim Craig. In the three distinct sessions, we will then listen to the initial response from EFRAG's representatives, Kathrin Schöne and Rasmus Sommer. We will hear from Chiara and Prete in the overall comments from EFRAG. And in the panel discussion, we will have Karina Vastveit-Hestos from Norsk Hydro and the analyst Theodor Sveen-Nielsen from SpareBank 1 Markets. The discussion will be moderated by Erlend Kvaal, an academic and also a TEG member. The objective of this outreach is to provide a Norwegian perspective on the proposals, and this will later be sent through to the IASB through our comment letter from NASB, and further, maybe we have some input to EFRAG's final comment letters still in the making. And as you may know, due to the coronavirus, the due date for the comments have been extended until the end of this year. So we're pleased to have Tom Scott from IASB as the first speaker, who will give a brief introduction to the discussion paper. And following immediately after Tom, we will have Chiara del Prete, the EFRAG TEG Chairwoman, to present the opening remarks from EFRAG. So without further ado, I welcome Tom Scott, a board member of the IASB for the last 3.5 years. Please, Tom.
Thank you. So good morning, and thank you to all of you who are attending this event to discuss the IASB's discussion paper, Business Combinations, Disclosures, Goodwill, and Impairment. Before we start, some housekeeping. As with all our presentations, any views we express today are our own views and may not necessarily be shared by the rest of the International Accounting Standards Board or the IFRS Foundation. This is an important set of proposals for the IASB. Investors are really keen to receive better information about acquisitions, both at the time that acquisitions are made and to understand subsequent performance. As many of you know, the thorny question of subsequent accounting for goodwill is one that has been of interest for many years and tends to give rise to polarized opinions. Questions have also been raised about the effectiveness of and the complexity of impairment testing for goodwill, and also the timeliness of the recognition of any impairment. I encourage people to respond to the discussion paper. We could advance a slide, please. So to start with, slide 4 provides an overview of our project on goodwill and impairment. The IASB started this after a post-implementation review of IFRS 3 and published the discussion paper in March. The deadline for submitting comments letters is the 31st of December 2020. While many think this is a project about the accounting for goodwill, in fact, the objective of this project is broader. The objective is to improve the information that companies provide to users of financial statements at a reasonable cost about the businesses those companies acquire. The IASB hopes to help investors hold management to account for those acquisition decisions. The discussion paper contains a number of specific questions for stakeholders. The IASB is particularly interested in hearing from stakeholders on how useful and feasible they think the new disclosure ideas are, as well as whether they have any new evidence or arguments on the best way to account for goodwill. The IASB's preliminary views are as follows. They cover three main areas and reflect concerns the IASB heard from stakeholders. The first area relates to disclosures. The IASB's preliminary view is that it should propose to require companies to disclose information about how business combinations perform after the acquisition. The second area relates to improving the accounting for goodwill. The IASB explored whether it could make the impairment test more effective, but its preliminary view is that it is not feasible to improve the test significantly at a reasonable cost. The IASB then considered whether to propose reintroducing amortization, and the IASB's preliminary view is that it should not do so because there is no compelling evidence that doing so would significantly improve financial reporting. Finally, the IASB explored some possible simplifications that would reduce the cost of performing the impairment test by removing the requirement to perform the test annually and amending how value and use is estimated. The third and final area relates to some other topics. The IASB's preliminary view is that it should require companies present total equity excluding goodwill on the balance sheet. The IASB also thinks it should retain the current approach of requiring companies to recognize identifiable and tangible assets separately upon acquisition, rather than subsume some of these intangible assets into goodwill. We will only be discussing selected topics from the discussion paper today. However, we've included a few slides in the appendix that cover other topics in the discussion paper. It is perhaps worth emphasizing here that the views in the discussion paper are preliminary. Depending on the feedback and comments that the IASB receives from outreach, events such as the one today and comment letters, the IASB may decide to reconsider some or all of these preliminary views. So thank you, and I hope you enjoy the rest of the presentations.
So Chiara and Prete from EFRAG, please.
Good morning. Good morning to all of you, on behalf of EFRAG, I'm pleased to have organized this event, which is the second in this 2020 joint EFRAG-IASB outreach season, undertaken in cooperation with the Norwegian Accounting Standard Board and the Norwegian Society of Financial Analysts after the successful event that we recently had on PFS, on the General Presentation and Disclosure. Few words on EFRAG position and EFRAG work on goodwill. Goodwill is a relevant topic for EFRAG and in general for Europe, and it has been on our research agenda already from 2015. We're pleased also to see that some of our ideas from the discussion paper back in 2015-18 have also been taken on board by the IASB in this discussion paper. We issued our letter the 29th of May, with comment period open until the end of this month of November. And you can find also on our website a link to a survey with the preparers. So there is still a few days if you want to participate as preparer to EFRAG survey on this discussion paper. In general, we support very much the objective of the discussion paper. And we agree that there is a problem with the information that users currently get about the goodwill and about the performance of the acquisitions. We support the direction for the disclosure on how business combinations are performing. However, we see that the primary problem here is the accounting for goodwill. And so we would like to the IASB to consider and articulate a little bit better how this new disclosure could serve as a starting point also for the impairment test and to understand the recoverability of goodwill on balance sheet. user says that reporting for goodwill has limited relevance today for many reasons, including that there is a so-called shielding effect. The allocation of the goodwill is done at a high level to be tested, is not tested directly. So we note that the IASB rules out a major change into these impairment approach. Nevertheless, we invite them to consider a number of enhancements which will be illustrated by my colleagues in the rest of this presentation. We are also consulting the constituents on a number of issues. Tom Scott mentioned the polarization of the views on amortization for goodwill. Well, we didn't want to preempt any outcome of the discussion. That's why in our comment letter don't yet form a view on the amortization of goodwill. So we are eager to listen also from your perspective and point of view where you are. So thank you, and I hand over again to Bjørn for the next session.
Thank you, Chiara and Tom, for your opening remarks. In this event, we'll focus on certain of the proposals. We have selected like three main aspects of the proposal for you guys. And just to have a little we're testing the polling system now in the beginning of the session, because we want to have this as interactive as possible. So if you have the poll ready on your screen now, please indicate your response so we have a little grasp of the composition of our today's participants. I can see from the participant list that there are almost 25 international participants, which is an interesting treat with today's connected world. So it will be mostly Norwegian perspectives, but we're thrilled that we also have a international outreach here. So do we have? I think we have to remind you also that there is a chat window on this where you can write your questions on the bottom of your screen. These will be moderated by Morten Haukaas from Equinor, and we'll later come back to that and present to either the panelists, or you may actually direct your questions directly to IASB or EFRAG as you see fit. So let's see how this polling works out. So we see that there's a quite dominant proportion of these that are from the accountancy profession. We have a quarter of preparers, which is good. As usual, we have maybe too few users present. The numbers are changing a bit over time. So with every category represented, I will hand it over to the first to the moderator for the next three sessions, which is Erlend Kvaal. So Erlend, please introduce the first main topic for today.
Thank you, Bjørn Einar. I'm Erlend Kvaal, and I will moderate the panel discussion. So we have four panelists, and we have three topics. The first is about improving disclosures, about business combinations. So I think I will just ask the panelists to follow each other one after the other. It starts with Tim from the IASB, and then he will be followed by Kathrin and Rasmus from EFRAG, and then we have the Norwegian panelists, the producers, analyst Theodor from Sparebank 1 and Karina from Norsk Hydro. So when Karina has finished, I will take back the word. So please go ahead, Tim.
Thanks, Erlend, and good morning, everyone. Okay, so we'll now take a look at the first of the topics we'll discuss today, and that's the IASB's preliminary views on improving disclosures about acquisitions. One of the key messages that the IASB has heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well a business combination has performed post-acquisition. Investors want this information to hold management to account for its decisions to acquire those businesses. Most investors told us that the information is needed for stewardship purposes to help them, for example, determine whether they can trust management with future capital. Existing standards do not specifically require companies to disclose such information, and hence any information that is provided today is disclosed voluntarily. Therefore, the discussion paper explores whether to require companies to disclose information on the subsequent performance of business combinations. The IASB's preliminary view is that it should require companies to disclose in the year of acquisition, firstly, the strategic rationale for the business combination. The rationale would be a high-level statement that links the business combination to the entity's overall strategy. Secondly, the key objectives of the specific business combination, these being the more detailed aims that management intends to achieve as a result of the business combination. And thirdly, the metrics and targets that management will use to assess to what extent those key objectives are being achieved. Then in subsequent periods, the company would disclose the business combination's actual performance based on those metrics to enable users of financial statements to assess to what extent the key objectives identified at the acquisition date are being achieved. So what kind of information do companies need to disclose in the subsequent years? So the next slide, slide 11, looks at that question. There's a wide range of business combinations and they serve a wide range of purposes. So the IASB concluded that no single metric would be suitable for every business combination. Therefore, the IASB is exploring a management approach. In other words, the metrics disclosed would be those an entity's management uses internally to monitor whether they have met the objectives of the acquisition. Such measures could be operational or financial or a mixture of both. Because acquisitions can often involve large sums of money, the IASB presumes that most companies are monitoring their major acquisitions. But if management is not monitoring a business combination, the IASB believes that the company should disclose this fact rather than the IASB prescribe a minimum set of information to be disclosed. And when we say the information being used by management, what do we mean by that? The discussion paper proposes that we use the perspective of the company's chief operating decision maker, which is a term that's used to identify the disclosures required for segment reporting under IFRS 8. The main reason why the IASB is suggesting using the chief operating decision maker as a threshold in this new context is so that companies disclose the most important information about the most important business combinations. A lower threshold might result in excessive and costly disclosures, particularly for companies that make many acquisitions. However, the board would like feedback on whether using the chief operating decision maker as a threshold would lead to companies disclosing all the material information that investors need about the business combinations they want to know about. The IASB is aware that some stakeholders have various concerns about providing this information. For example, what if the acquired business is integrated with an existing part of the business post-acquisition? The answer to this depends on how management is monitoring the success of the business combination. For example, the chief operating decision maker may be monitoring the performance of the business combination using information about the combined business rather than the acquired business in isolation. In that case, the company would disclose information on those metrics about the combined business that the chief operating decision maker is using. The principle here is to disclose the information that management uses internally to monitor business combinations. The IASB is not expecting companies to create disclosures to satisfy the requirements, but to disclose the information that management are already using internally. Sometimes, when we discuss the IASB's preliminary review on the subsequent performance disclosures and the issue of integration is raised, it sometimes sounds like it prevents companies from monitoring the business combination, and that therefore, when integration occurs, management do not know how well a business combination is performing. However, when we have the opportunity to discuss this further with stakeholders, we often find that management are still monitoring the business combination in some manner and are aware how well a business combination is performing, at least in the early years, which is what the IASB expected. The discussion paper discusses other concerns that the IASB has heard, including whether this information is commercially sensitive and whether it's verifiable. The IASB wants to explore these concerns with stakeholders and hopes stakeholders raising these issues will also help the IASB find ways to address them, since, in the IASB's view, it is reasonable for users of financial statements to ask for companies to provide information that will help them understand better how a business combination is performing. In short, a plea to help us to work something out that works for preparers and helps investors, as this is an area that's important for investors. One final point to make on the subsequent performance disclosures is that some stakeholders have said that the IASB is asking for information of a type that should be included in the management commentary rather than the financial statements, because, for example, it's strategic, it is management's view, it's analysing the performance of a part of the business, and it could involve non-GAAP measures. Nevertheless, the conceptual framework is not a barrier to including such information in financial statements, and investors have said they're not getting enough information today on the subsequent performance of acquisitions, there being no or at least minimal requirements in IFRS to provide this information, and therefore any information investors are getting today is being provided voluntarily by companies. In determining its preliminary view to propose including this as a disclosure requirement in the financial statements, rather than something that companies might volunteer to provide in their management commentaries, the IASB put weight on ensuring the information is made available to all investors. The IASB would like to hear from those stakeholders who do think this information should be included in the management commentary. For example, whether they think companies can be encouraged to provide this information. So moving on to slide 12, this slide summarises the IASB's preliminary views on some other targeted improvements to existing disclosures included in IFRS 3. These proposals are about the information provided in the year of acquisition, which include requiring the disclosure of expected synergies, defined pension liabilities and debt assumed, as well as some changes to the actual and pro forma information disclosed about the acquiree. So that covers the IASB's preliminary views on disclosures, and I'll hand over to Rasmus now.
Thank you, Tim. And as it appears on slide 13, EFRAG's preliminary review is that most, but not all, of the proposed disclosures in the IASB's discussion paper in principle would be useful. However, as it appears on the next slide, slide 14, EFRAG notes that the proposals are related to business combinations and as such do not solve the issues related to goodwill accounting. In its draft comment letter, EFRAG notes that it could have been beneficial if the information on the success of an acquisition, in the case that it would involve a substantial amount of goodwill, could also be used to assess the reported goodwill figures. If the objectives of an acquisition would not be met, this could indicate that the acquired goodwill would be impaired, but because of the shielding effect, an impairment loss might not be recognized. However, the approach suggested in the discussion paper will not be particularly useful for this purpose, as information would only be provided to the extent that it is used to monitor the acquisition by the management. Nevertheless, a side effect of the proposal could be that the level at which an acquisition is monitored would be an indication of the level at which goodwill should be tested for impairment. EFRAG disagrees with the proposals that the disclosures on the objective of an acquisition and whether these have been met should be based on what the chief operating decision maker monitors. EFRAG tentatively considers that the information should be based on what is monitored at a lower level. EFRAG questions the reliability of the information related to the objectives of an acquisition and the synergies and acknowledges that some consider the information to be difficult to audit. EFRAG accordingly questions whether the resulting benefits would outweigh the costs. EFRAG has not yet formed a view and is consulting its constituents on whether it is practical and appropriate to disclose the proposed information in the financial statements instead of providing the information as part of the management commentary, as the information is based on management's expectations and refers to non-GAAP indicators. And then some specific comments. EFRAG's tentative view is that an entity would have to disclose if it stops monitoring an acquisition within 3 years instead of the 2 years proposed in the discussion paper. And EFRAG does not consider that the proposed requirement to also provide pro forma information on cash flows from operating activities would result in particularly useful information. And then on the next slide, slide 15, you can see that EFRAG is concerned that the proposed disclosures might require entities to present commercial sensitive information. And EFRAG accordingly supports that the IASB is doing further activities to understand this issue. EFRAG is thus interested in learning whether preparers assess that the proposals would mean that they would have to disclose commercial sensitive information. As mentioned, EFRAG is also uncertain whether the disclosures would be better placed in the management commentary. Some users EFRAG has spoken with have been of the view that the information should be presented in the financial statements as they consider the information to be important. However, some other stakeholders have noted that the information is forward-looking and as such is better placed in the management commentary. In addition to learning about operational implications of the discussion paper's proposals, its cost and the expected reliability of the information, EFRAG is also interested in learning about any constraints within jurisdictions that would conflict with the suggestions. In relation to the pro forma information, EFRAG notes that the manner in which business combinations are accounted for is disruptive for analysts' trend analysis. For example, when inventory is remeasured at fair value following the purchase price allocation, profit margins after the acquisition will not anymore reflect an estimate of the entity's future profit margins. EFRAG observes that the alternative performance measures are used to eliminate from operating profit the impact of the effects of the purchase price allocation. EFRAG has therefore considered whether it would be more useful to present further modified figures than operating profit before acquisition-related transaction and integration costs. In addition to excluding acquisition-related transaction and integration costs, such a figure could also exclude the effects of the revaluation to fair value. Although EFRAG considers such figures could be useful, it is unsure how costly they would be to prepare. Accordingly, EFRAG is consulting on this issue. Finally, EFRAG is interested in understanding how users would react to information that an entity is not monitoring a significant acquisition, and an input on whether any of the current disclosure requirements in IFRS 3 could be removed without depriving investors of material information. And then I will hand over to the first panel debate, and first to Karina Vastved-Hesters.
Thank you, Rasmus. My first sort of comment is that we fully understand that the users of financial statement need good information. They need information about the significant acquisitions, why they're done, how they're done, and how they are performing. But we are a bit concerned about how this can be regulated, as there are so many differences, and what is good information about an acquisition that depends to a large extent on the situation and how the business is composed, the complexity, the size, the industry. There's a number of things that impacts what makes the information, or what information is the most relevant. So our our concern is that any new requirements will be specific and lead us into providing information that isn't relevant for our acquisitions, and that may be costly and complex to prepare. So we think it's important how these regulations are formulated and set in the end in a standard, not to avoid giving relevant information, but to make sure that the information is tailored to the situation. And that is really difficult to foresee in a standard setting process where you set a list of disclosures. We do agree that the strategic rationale is something that it makes sense to give information about. Our practice has been that is done when an acquisition is published to the market. So it's done more in a sort of market communication, real-time situation, and not necessarily brought into the financial statements that can be issued several months later. So that is a change that I see that will be important for my company. But that's clearly doable. How to report on targets and expectations, that's also very different for different types of acquisitions. How you plan to manage them afterwards, how integrated they will be in the existing business and potential future acquired businesses, that impacts what type of measures that make sense to use. And sometimes it's not fully determined which measures you will use. You know that there are certain aspects that you will monitor, there are certain aspects that are important, but until you have full access to the acquired business and know how information is captured, it can be difficult to say exactly how you will measure that. And things also change over time, so measures that businesses focus on changes over time. And of course that also impacts how you will measure the success of something like a significant acquisition. I think the information at the acquisition time is more easy to compile and provide than the the information after the acquisition. So it's very different if it's a standalone business that is continued to be managed either as a separate business area or segment, or as a separate geographical operation, so that you have a separate set of information about that business. If it's integrated into one or more existing segments, for instance, it's different, and it's more about following up the combined business than the acquisition as such. And the acquisition is one aspect of what you're following up, but it's also about all the other aspects of that business. So the numbers and the information that you will provide is not necessarily so focused on the acquisition, because that's at least over time how businesses are followed up in my experience. So when you have a corona situation, for instance, the numbers that you look at are very different from what you thought a year or two ago that you would be facing. So it's also about reacting to situations and events and what's happening after the acquisition as such. It's also the macroeconomic situation and all of that we all need to respond to as things happen. And in my experience, we monitor the acquisition as such for some time. How long depends a lot on the complexity and what else happens in the business. And after a while, you move over to following up on the business that you have. and setting targets and following up on that, and not really being so concerned about that parts of it is acquired and parts of it has been developed as organic growth. So the period that we follow up, I think 2 years is a reasonable trade-off on how long it's fair to say that you follow up the acquisition as such, and when you transition into a situation where you follow up on the business as such. If it's a standalone separate segment, for instance, it might easily be followed up on a standalone basis for a longer period, but in my experience from the company I'm working with, that is not the most common situation. Most businesses that we acquire are integrated with existing businesses, and that also means that it's difficult to sort of keep them apart and to follow up on those aspects for a very long time. So on the regulation of this, I think it's important that the regulation is around clear disclosure objectives rather than specific requirements, and that specific requirements for sort of specific measures is avoided, because that would be too burdensome for companies who have elected to follow up on other, for them, more relevant aspects of the acquisition. So that's some comments from the preparer side, with the preparer experience in mind. And with that, I hand over to Theodor, who will have other views, of course, because he's the user of this information, and finding the right trade-off between us is what we're all searching for.
Thank you for that, Karina, and good morning to all of you. Just to clarify this, as Karina said, I'm a user and not a producer, as it was mentioned initially today. So my views on the board's proposal regarding the strategic rationale for acquisition is, I'm not sure if that's very important, at least for me as a user. And some of the reason for that is, at least in my experience, that's often reported in relation to the announcement of the acquisition. And I'm not sure if that should be an integral part of the financial reporting going forward when it comes to the strategic rationale of the acquisition. Firstly, many investors and many users, they will in any case have their own view on the rationale and whether that's a smart decision or not for the overall business. And secondly, I think that the requirement of disclosing the strategic rationale for the acquisition going forward may lead to less precise disclosure and just some general comments just to fulfill the requirements. And also that maybe the information around the strategic rationale could be less reliable, at least going forward when the macro environment changes. So for the first point, when it comes to the rationale behind the acquisition, I'm not sure if that should be a part of the financial reporting. And then second, when it comes to the disclosure around objectives for acquisitions, my view is very much the same as I described now. I think that's often announced in relation to the announcement, or disclosed in relation to the announcement of the acquisition. It could change over time, and also maybe some of the information that is provided by the company is less reliable. When it comes to the third part of the proposal, metrics for monitoring performance, I think that is very important, at least if the acquisition has a meaningful size relative to the overall business. It's very important for outsiders to be able to monitor performance of acquisitions and monitor the performance of management's decisions. For example, if you get some information around acquisitions, it may increase confidence around management's value creation skills, and that will have direct implications on valuation multiples and also the market's required return on the company's equity and debt. I think also that disclosing some metrics where you can monitor the performance of acquisition may also reduce losses related to potential unsuccessful acquisitions, as it will get more focus from investors, analysts, and media in general. And just one example there is on the right-hand side of this slide. I just included some highlights from what the Norwegian Financial Daily have written about Equinor and the losses in the US. And my personal view is that I think these losses maybe would have been cut off earlier if the company reported the US operations as a separate segment. Of course, positive to see now that the company has elected to split that as a own segment, but that should maybe have been done before. And then just my final comment here: what do we need as accounting users to be able to monitor performance? So at least three numbers we need. Number one is the acquisition price plus potential earnout or contingent consideration. Number two, we need capex or investments that are made after the initial investment. And thirdly, we need some kind of measure for the profitability, and that could be, for example, adjusted EBIT or some kind of P&L measure, or it could be a cash flow measure. And it's also important to have these three numbers on a consistent format and also preferably on the same format over time. And just finally here there's been some discussions around the period for the follow-up reporting here. I don't have any strong views on that. Of course, it's if it's an important part of the business, it should be longer than 2 years. But I also acknowledge the fact that acquired assets often will be an integrated part of the business. So it's maybe less meaningful to disclose specific information on acquired assets for many more years than 2 years. So that's all from me. Thank you.
Thank you, all panelists. Then the moderator takes the word again. We have only a very few minutes for a discussion, so I don't think we can discuss all views that has been advanced in this. But I think that I would suggest that we just take a round of the panelists, and what I think that I would ask IASB and EFRAG to comment upon was the things that Karina took up with the question of whether. So I understand that Karina's concern, among other things, were that business combinations are different in nature. There are variations, and then I would like to ask whether the suggested principles are sufficiently flexible so it does not make unnecessary constraints. So that's one thing that I want you to comment upon. And then the second I want you to comment upon is about the Theodor's point that maybe there is too much emphasis on, if I heard you correctly, too much emphasis on strategic rationale and objectives, and maybe more emphasis on useful metrics. Then after we have heard your view, then I would challenge Karina and Theodor to give a very short opinion about the question of whether the principles asked or whether the draft asked for too much sensitive information, and whether the management commentary would be a useful place for these information. So can I just ask Tim to start, and then you follow just in the same order as the presentations. Thank you.
Thanks, Erlend. Yeah, that's fine. So I think on Karina's comments around that it depends on the acquisition. There are different acquisitions done for different reasons, and companies will have different objectives and so on and so forth. And I think Karina was saying that there needs to be some flexibility over the disclosures. And I think that's what the board had in mind when it effectively adopted a management approach for this, that the board thought that it wasn't able to prescribe a specific measure or metric that would work for all acquisitions, and it really depends on the acquisition. And so that's why the board has adopted a management approach, and hopefully that will allow companies to use whatever metrics they think are the most relevant for an acquisition, because acquisitions are different, and whatever their management are using, that is what the disclosure needs to be around. So hopefully that approach will sort of address that issue. I mean, it gives the flexibility. I wouldn't necessarily call it flexibility in that actually it's requiring whatever management are using internally to be disclosed, but it allows the disclosure to reflect what management are using. And that might actually also provide some interesting information to investors about how the business is being managed, how acquisitions are being managed, and give some insight into the company and the management. On Theodore's comment on the strategic rationale and the objectives, possibly that's because Theodore, as he said, he's already getting it already in the announcements, and at the time of the acquisition. I mean, I think the objectives. I mean, the strategic rationale is really a disclosure that sort of is trying to link the acquisition to the group strategy, and that might be somewhere elsewhere in the annual report, like the management commentary. I think the objectives are particularly important because actually the metrics that we're talking about are the metrics that are used to show how well an acquisition is performing, how well it's achieving against those objectives. So I think the objectives are a very important part of this, and with those objectives, users will understand better what management are intending to do with the acquisition and give some insight in what management feel the acquisition will add to the business. But there's an important link there with the metrics themselves and why the metrics are relevant. And again, it's giving some insight to investors, because if the metrics don't link to the objectives, if they're not particularly good metrics in the investor's eyes, then there could be a market reaction as a consequence of that. So I think that's the only couple of things I've mentioned on those two aspects.
Thank you, Tim. And if I can provide a view also from the EFRAG perspective on this first point. On the strategic rationale, we agreed to include these elements in the disclosure. We agreed with the perspective that was just described by Tim. On the fact that any business acquisition as a business combination has got its own specificities, we absolutely agreed with the IASB on the necessity to go for a managerial view. So we supported the idea of the management having the flexibility to define which are the operating or financial KPIs that are used to monitor the acquisition. What came out from our preliminary discussions with the users that contributed to form our draft comment letter, including our user panel, was that the level of CODM, Chief Decision Operating Maker, was perceived by the users to be sometimes too much high level. They were skeptical about the robustness of attaching the disclosure at that level. So we suggest the IASB to consider again this level and perhaps go to a more granular approach for the monitoring. In terms of the point on commercial sensitiveness that you mentioned, Erlend, this is one of the key points that we are assessing with the preparers in our surveys, and it seems that we need really this time to find a good balance between the two perspectives, the user's need and the preparers' issues with commercial sensitiveness, because some preparers have said that too much disclosure too early can also put at risk the realization of some sensitive synergies, like, for example, imaging cost-cutting coming from agreements with trade unions for redundancies or something of that sort. So this is something that our Goodwill team is carefully looking at with the preparers in the surveys.
Oh yeah, I think I might be next in line then. We think that the chief operating decision maker is a sensible level to put the requirements on. Then I think we will capture those that are quantitatively or qualitatively important acquisitions, while we will not require information about smaller acquisitions or less important acquisitions, which of course can be added on a voluntary basis if that is considered good for marketing or information policies to the capital markets. But requiring a lower level will potentially be very demanding for very active companies in M&A transactions. So I think it's a relevant balance. And also, we like the management approach to this. I think it's a good way to tailor the information to what a company is using, what a company is following, and in that way, what the company finds important for its particular acquisitions and circumstances. So I much prefer that from a list of metrics that you normally would provide and have to argue against when you discuss what to disclose. So, as I said, acquisitions are quite different, and that means that the targets are different, and the metrics that you use to measure whether you meet those targets are different. And how long you will have financial information that says something sensible about the acquisition as such depends on how quickly you integrate, what you integrate with, where the relative sizes of what you integrated into compared to the acquired entity, whether it's integrated into more than one segment or just one place. So it depends on the facts and circumstances. You had one more question, I think, Erlend. The commercial sensitivity. And that is always an interesting discussion internally. What is commercially sensitive? What can we say without jeopardizing the possibility of reaching our targets? And I think often it's possible to find information that gives relevant information to the market without being so specific that it harms our commercial position. But there are situations where that can be quite challenging, and the more specific you are on, say, price expectations on how you will achieve those synergies, what you will do specifically in the market, and which costs elements that you will be able to take out. And then, of course, it's the employee side that is most sensitive. That's not necessarily a commercial issue as such, but more other types of sensitivities. That is challenging, but it's also about timing. So if you report on that in an annual financial statement that is released after you have taken the first steps, it's less sensitive than if you do it on the acquisition date when you have not started to implement anything. So it's a lot about timing as well. And it's a balance. It's always a balance. So I think, again, that having clear objectives rather than specific requirements is a better way of addressing this. And the way the discussion paper is formulated, I think that is going in the right direction. But it's always interesting to see how those initial thoughts are implemented into standard language when it comes to setting the actual requirements in the paragraphs in the standard. So that's when we will really see whether it's our interpretation of these principles that it's not that difficult, it's possible to live with this, or whether it becomes more specific than we currently think it might be. So that's going to be interesting to follow in the next session, sequence of this project. Thank you.
Okay, then I think it's me maybe. Erlend, as far as I understood, you had two questions for me, one around the rationale and one around the sensitivity of the information. Just some more comments on the rationale for the acquisition. Of course, it's always useful to get into the heads of management and how they think around strategy going forward. But I think, just to repeat myself, I think there's some risk of that. These comments will be very general, less reliable, and probably less useful for investors. And when it comes to, and also, of course, if management is forced to say something about the strategic rationale and say something where they actually could be measured after the acquisition, there's obviously some risk of being too careful, meaning that they really want to over-deliver. So I don't think the market will read too much into the strategic rationale if they disclose more information about that. And when it comes to potential sensitive information, well, it goes back to what I said in my introduction, that I think it will be, there's a risk of having too general comments, just adding a lot of unuseful information in the financial reporting that will then make important information more difficult to actually find in the report. Did that answer your questions, or?
I think we have had a lot of interesting views and good answers, so we will leave it there. I now hand over to Morten for the polling questions.
Thank you, Erlend. And as you have seen on the screen, we posted 2 poll questions for this session. The question 2 was with regard to will the IASB proposal of disclosure of management objectives for an acquisition and subsequently about meeting those objectives provide useful information to assess management stewardship. And the question 3, do you think that it's possible to disclose information on the achievement of the targets initially defined at acquisition date and of expected synergies without triggering commercial sensitivity? So if you have not already answered, we encourage you to give your reply so we can see also the opinion of the viewers of this session. I will also use the opportunity to remind you to use the Q&A field. This is your opportunity to ask questions, and then we can direct to the panelists. So please do that. Based on the preliminary responses, we see a clear tendency towards acknowledging that the proposal from the IASB that more information is useful, but also you see people also assessing the complexity or reliability or ability to provide that information to the public through a disclosure. And preliminary results also on the question 3, you can see again, says yes, information should be provided, but it could be difficult to provide such information. So maybe I can turn it back to the panelists for some initial comment on the responses we see from question 2 and 3. And then maybe we can go to EFRAG.
I mean, I can start quickly. It's Tim here. I mean, on commercial sensitivity, I think, if I'm reading this right, that most people are saying that it is possible to provide the information without it being commercially sensitive, whereas I think the most popular answer is that actually sometimes it'll be possible, sometimes it won't. And the least popular is that no, it will trigger commercial sensitivity. I mean, commercial sensitivity is a really important issue here, as Chiara mentioned, and it's something that obviously the board is very keen to hear stakeholders' views on. I mean, investors do tell us that at the time of the presentation, at the time of the announcement of the deal, there are presentations, there are press releases that have a lot of information within those, the strategic rationale, the objectives, and some targets. And quite often there's some detailed targets in there, and all investors are looking for is follow-up information on those targets. And so investors say, surely that can't be commercially sensitive because, you know, companies were willing to provide it already. And as Karina says, maybe investors aren't necessarily looking for very specific, detailed, granular information, and it's maybe when you get into those specifics and the sort of granular details that the information might become more commercially sensitive. And so, but the board is really interested to hear stakeholders' views on this particular topic, and if stakeholders do think some of this information could be commercially sensitive, I think the board would really like to hear some examples of what type of information could be commercially sensitive. Why do those stakeholders think they are being asked for that type of information that is commercially sensitive, and what sort of competitive harm do they think could arise if they do provide that information? And I think that the board would find that sort of specific feedback, as well as feedback that yes, some of this information could be commercially sensitive, as that polling question sort of indicates. I think the board would like to have a little bit more detailed feedback on precisely what type of information do companies think would be commercially sensitive, and why is it commercially sensitive. I think would be really useful for the board.
And if I should continue then from the EFRAG perspective, not to just repeat what Tim Craig said. Of course, EFRAG also acknowledges that some information could be commercial sensitive, but as Chiara also mentioned, if we are going to find a balance, it would also be useful for us to know, because we know that some information about the objectives of an acquisition can probably be disclosed, but other information cannot. One of the questions is then, is it useful to disclose part of all the objectives and monitor an acquisition based on those objectives, or do you also need to have additional information? We have carried out some outreach activities, and for example, what we have heard there is that yes, one objective could be that we would have a turnover from a particular acquisition at a given amount. But if we only disclose that figure, what we will not disclose, but because that could be commercial sensitive, is the cost to receive that turnover. So in fact, it could be that we can report that we have met the objectives by saying, yes, we have had that turnover, but what users would not see is the cost that we have spent to achieve that turnover. So if we only disclose part of the information, the part that perhaps may not be considered commercially sensitive, is that then useful, or is it not so useful because we are not disclosing another part of the information that could be commercially sensitive?
Okay, thank you very much. Then I take the word again. I think we move on to the next topic, which is improving the impairment test. And we are approximately on time, so I give over the word to Tim again, and we just keep the same order. Thank you.
Thanks, Erlend. So we'll now discuss the other main topic in the discussion paper, which is the subsequent accounting for goodwill. Two key pieces of feedback were that stakeholders said that impairment losses were recognised too late. Investors have often reflected reductions in their valuations long before impairment losses are recognised by companies. And secondly, stakeholders said that the impairment test is costly and complex. In response to this feedback, the IASB explored whether it could make the impairment test more effective at recognising impairment losses on acquired goodwill on a more timely basis. The IASB also discussed some ideas to make the impairment test less costly, and we'll take a look at those ideas in a moment. The IASB identified two possible reasons for the too late issue: cash flow forecasts that are too optimistic and shielding. On the first issue, IAS 36 requires management to use forecasts that are reasonable and supportable, to assess the reasonableness of assumptions by examining the causes of differences between past forecasts and actual cash flows, and to assess the reasonableness of those past forecasts. In addition, companies are required to disclose information about the assumptions used to provide users of financial statements with information to assess the reliability of impairment tests. The IASB's preliminary view is that if forecasts are too optimistic, this is more of an implementation issue that's better dealt with by auditors and regulators than by standard setting. Slide 21, if we can move to that one, please, explains the second issue, which can lead to impairment losses on goodwill not being recognised when stakeholders might think they should be, which is shielding. Before we start, an important point to mention here is that the impairment test is not a direct test of goodwill. Goodwill does not generate cash flows on its own. It can only generate cash flows in combination with groups of other assets, and so can be tested for impairment only with those other assets. Goodwill is therefore tested for impairment indirectly by testing a cash-generating unit or a group of cash-generating units. The unit of account for the test is the cash-generating unit. So this slide provides a simple illustration of the shielding issue. And on the left-hand side of the slide is the acquired business, and something's not turned out as expected, and an impairment loss would be recognised if the acquired business was tested in isolation. However, in most cases, the acquired business is integrated with some other part of the acquirer's business, often to achieve synergies management expected from the business combination. In this example, the acquired business is integrated into one of the acquirer's existing businesses, and there's significant headroom in that existing business. Its recoverable amount exceeds the carrying amount of recognised assets. And maybe that's from internally generated goodwill that's not been recognised, or unrecognised intangible assets, or simply because the fair values of the recognised assets are higher than their carrying amounts. Because in this example, the combined business is tested for impairment as a cash-generating unit, no impairment loss is recognised since, as shown by the right-hand side of the slide, the combined recoverable amount exceeds the combined carrying amount of the assets of the combined business. The headroom of the existing business is shielding the acquired goodwill from impairment. Hence, this simple example illustrates a too late issue. Shielding occurs in the current impairment test because the reduction in value is first absorbed by the unrecognised headroom. An impairment loss is recognised on the acquired goodwill only if all of that headroom is being used up. So moving on to slide 22, I think it is. The IASB looked at an approach to reduce the shielding effect, incorporating the headroom into the impairment test. This approach compares the recoverable amount to the carrying amount of the recognised asset plus the headroom from the previous impairment test. This prevents the prior period headroom automatically absorbing any reduction in value of the combined business. Any impairment that results, basically any reduction in the headroom since the previous test, still needs to be allocated between the acquired goodwill and the unrecognised headroom. However, the approach attempted to allocate at least some of the reduction to the acquired goodwill, whereas in the current test it's first allocated to the unrecognised headroom. However, any allocation would still be imperfect because it's not possible to tell how much of the reduction relates to the acquired goodwill and how much of the reduction relates to the unrecognised headroom, since goodwill is not directly measurable. In addition, the approach would be costly. So the IASB's preliminary view is that it's not feasible to design a different impairment test that's significantly more effective than the current impairment test in IAS 36 at a reasonable cost. The IASB accepts the test is not perfect. Because goodwill has to be tested with other assets, some degree of shielding will likely always occur. The test will not always provide a signal of how well the business combination is performing, but this does not mean the test has failed, as some people say. And although cash flow forecasts will always be judgmental, applied well, the test should meet its objective of ensuring the carrying amount of the cash generating unit as a whole is recoverable. And the disclosures proposed on subsequent performance that we went through earlier should provide better information about the performance of a business combination than the impairment test can. In fact, providing such information is not the purpose of the impairment test. So if we can move to the next slide, please. The other feedback from stakeholders during the post-implementation review was that the impairment test is costly and complex to perform. Hence, the IASB considered whether there were ways of reducing the cost of performing the impairment test without significantly impacting its robustness. One of the reasons given for the cost of the test by companies is the requirement to perform the test even when there's no indication of impairment. The IASB's preliminary view is that it should remove the requirement to perform a quantitative test annually. Instead, companies would need to assess at each reporting date whether there's an indication of impairment, and if such indication exists, a company would have to perform the quantitative test. This change should reduce costs for companies. However, there are mixed views on the extent of this reduction, and there's also mixed views on the impact this would have on the robustness of the test. Some believe this introduces further judgment into the test, and not performing the test regularly could result in a decline in the expertise with which companies perform this test. Some also believe an indicator-based test should be introduced only if amortization is reintroduced. This was a preliminary view where the IASB's majority was narrow. The majority, however, considered the reduction in cost significant, which would help offset some of the costs of providing the new disclosures, and the reduction in the robustness of the test marginal. Performing the test when there's no indication of impairment is unlikely to identify a material impairment, and would provide little information to users of financial statements. Also, performing the test every year cannot solve the shielding issue, for example. Early feedback on the IASB's preliminary review and its impact on the robustness of the test is mixed. Some stakeholders are concerned that companies will find it easier to avoid an impairment if a quantitative test is only performed when there is an indication of impairment. And the IASB certainly wants to hear stakeholders' views on this topic. In particular, specific examples where these stakeholders might consider there to be additional judgments that companies must make when assessing for indicators of impairment, compared to where companies determine assumptions for a quantitative impairment test, or where those judgments made by companies are harder for auditors to challenge. The IASB also considers some simplifications to how value in use is estimated, which could in turn improve the impairment test. Currently, IAS 36 prohibits the inclusion of cash flows from an uncommitted restructuring or from enhancements or improvements to assets in the cash flow forecast companies use to estimate value in use. And stakeholders have said excluding those cash flows can be difficult, particularly determining which cash flows relate to maintenance versus expansionary capital expenditure. As well as reducing cost, removing this restriction could make the test easier to understand. Where an asset or a cash-generating unit contains the current potential to be enhanced or restructured, that will be reflected in the asset's fair value. If that potential is also available to the owner of the asset, it's logical that it's reflected in its value in use as well. However, there are concerns this change could increase the risk of cash flow forecasts that are too optimistic, and the IASB did consider whether to set a threshold for including these cash flows in value in use estimates or to require additional disclosures. However, the IASB considered the requirements in IAS 36 regarding reasonable and supportable assumptions that already apply to the other cash flows in value in use estimates should provide sufficient discipline over these cash flows as well. Thus, the IASB's preliminary view is that it should remove the restriction on including these cash flows in estimates of value in use without any additional threshold or disclosures. Stakeholders also commented that the use of pre-tax cash flows and a pre-tax discount rate to estimate value in use did not reflect how such estimates are performed in practice, generally being estimated on a post-tax basis, and that pre-tax discount rates are not observable. Hence, allowing value in use to be estimated using post-tax cash flows and a post-tax discount rate, which is the IASB's preliminary view, would make the test easier to understand and provide investors with more useful information where post-tax discount rates are disclosed rather than pre-tax discount rates. So that covers these parts of the IASB's preliminary views, and I'll hand over to Kathrin now.
Thank you. EFRAG shares the IASB's reservation on the possibility to develop a different and more effective impairment approach. However, EFRAG believes that there are collateral areas of possible improvements. In particular, EFRAG suggests to address some aspects of shielding by issuing different guidance in relation to the allocation of goodwill to CGUs. This guidance could be enhanced to improve how the test is applied in practice. EFRAG considers that the guidance could be clarified to help allocate goodwill to the lowest level possible that outweigh costs of impairment testing and information needs based on value relevance. There could be, for example, a rebuttable presumption that it is one level below the segment level. Rebuttable presumption means there could be reason that it is on segment level depending on the structure of an entity and the cash generation in that entity. EFRAG also suggests that the IASB could consider enhancing the guidance for reallocation of goodwill. It is currently driven by changes in the reporting structure, whilst changes in the cash generation should be considered as the basis for the reallocation. Making the strategic rationale of an acquisition more transparent in monitoring the success of an acquisition could help to better structure such tests and better identify triggering events for goodwill impairment testing. In addition, EFRAG suggests to address management over-optimism by developing some disclosure requirements. There are proposed possible disclosure solutions for better transparency of estimations made by management. EFRAG suggests for these different approaches. One would be a kind of back testing. The achievement of previous estimates could make over-optimism transparent. Information on the assumptions related to the period for which management has detailed projections could be made more transparent. For example, it could be disclose the growth rate in that period. At the moment, there is a growth rate for the terminal value, but the period until you go into the terminal value is not really transparent. Then there could be an approach to disclose the current level of cash flows or earnings to allow users to estimate future cash flows themselves. In relation to these, on the next slide, you can see that, therefore, EFRAG has several questions to constituents addressed that would cover those topics that I was referring to. It is about the allocation and reallocation level of goodwill, the management over-optimism. It is best addressed by auditors and regulators, as stated in the discussion paper, or should there such improved disclosure requirements? And we have been addressing as well the different suggested possibilities for addressing management over-optimism. We would like to understand the usefulness and the practicability of such approaches. And a last topic would be would allowing a reversal of impairment help to recognize an impairment loss a bit earlier in the financial statements. So is there at the moment a lot of pressure on the impairment testing because it is not, it cannot be reversed? That's one of the other questions. In relation to simplifications, EFRAG has a reservation against an indicator-only approach. In the draft comment letter, EFRAG concludes that there is a potential to achieve cost savings in adopting an indicator-only approach. However, there are reservations to remove the requirement to perform an annual quantitative impairment test because of a concern about the robustness of such tests. An impairment test is a complex process. If companies do not perform an impairment test regularly, their expertise in performing the test is likely to decline. Another concern is management over-optimism. The problem of management being too optimistic could be increased as auditors or regulators have no comparison to impairment tests prepared in previous years. EFRAG for sure note that there are cases where it is obvious already from the indicator analysis that there is no need for impairment, and as such the detailed calculation would not add useful information to assess the recoverability of the carrying amount. In these cases, EFRAG believes that an indicator approach may play a role, and the IASB could consider leveraging on what is already in paragraph 99 of IAS 36. An indicator-only approach might, however, result in a lower reliance by users on the results of the impairment test. This could potentially accentuate the too little too late issue and could result in further loss of information on governance and management stewardship of capital employed. As I said, EFRAG could be concerned that this could further reduce the effectiveness of the impairment test and the confidence on the reliability of the test. For the other simplification that you can see on the slides, that is something that in general EFRAG welcomes. So on the next slide, you can see that there, EFRAG has raised in this regard several questions to constituents. It is first of all whether the concerns are shared about the indicator only approach. Then there are some issues that would be addressed in connection to the other simplification. So should there be other cash flows considered when simplifying the value in use calculation? And there are some questions in relation to post-tax inputs. Is there a risk that impairment losses being undetected when using post-tax inputs? And then there is a general concern about maybe double counting things. So there is a question whether anyone has identified some risk factors in relation to post-tax inputs. So then I would be happy to hear about your inputs.
I think it might be me following now. Yes, here's a slide that I can recognize. And I must say that my views on this topic is significantly influenced by coming from a company where we have limited goodwill on the balance sheet. We have significant amounts of tangible and some intangible assets, and unfortunately quite significant experience with impairment testing of those the CDUs holding those assets, but the goodwill as such is to a large extent of a more technical nature, so it's coming from these residual components, not the true business value in a way. So it's challenging, I think, to find out how to deal with goodwill, as the starting point is that is an unallocated residual. So it consists of several things. It's wasting elements and it's long-lived elements. And one of the things that we always come up with from Norway when we talk about goodwill is, of course, the impact of how we measure tax in acquisition. So the nominal deferred tax creates some significant numbers from those industries that have, say, 78% tax rate as it is for oil and gas and 59% for hydroelectrical power. So that creates some interesting calculations. So we can identify those elements, but there are also other elements that in a way doesn't qualify for separate recognition. So it goes into goodwill, and increasing that element by allowing or encouraging intangible assets to be grouped with goodwill and treated as goodwill after the acquisition, I don't think that's a good idea. So I support the board in that conclusion. One other concern in a way is that there's only one way in practice out of the balance sheet for goodwill, and that is through impairment. So that is always perceived as a failure, even though we could have said it on the acquisition day that this goodwill will not last forever. So at some point in time, it will leave the balance sheet, and it will leave the balance sheet as an impairment. So that is hard to communicate both internally and externally, that those effects incur or exist as a consequence of the current regulation. Impairment tests. My experience is that the impairment tests should have the focus on the value of the CGU as such. The CGU may or may not contain goodwill. It may or may not support goodwill at a combined level higher up in the hierarchy. But the challenges are the same with and without goodwill in my experience. The annual impairment test, it has a cost. It has a not insignificant cost. And I don't think that an indicator-based test will be much less robust. I don't think we will lose much by moving to an indicator test. And we will definitely reduce the cost. So that is something that I would welcome. And the other improvement proposals, to include the effects of improvements or enhancements, that would reduce the difference to business planning and business logic and how management think. So I also support that. Of course, it needs to be sufficiently mature that it's supportable, and we have good documentation, good estimates for it. That's the same as with any other assumption that we put into an impairment test. But to sit with something that is approved, you know it's going to happen, you might have placed contracts, but you haven't incurred cash outflows yet. And then looking at the wording of the standard and saying that, well, it might not qualify, and then having that discussion, that is not very meaningful, because that doesn't add to the quality of the outcome of the test. So being able to include these elements that are sufficiently mature and clearly part of the value of the CDU as such, I welcome that. On the tax side, I'm a bit more concerned, because I think that the complexity will be there, whether the cash flows and discount rate is pre-tax or post-tax, because you have that built-in complexity with the way we treat tax, not at anything like fair value, but more as a nominal mechanical calculation. That's another problem, but it pops up as a complexity issue in this standard also. But I think we should leave that discussion to the point in time when we're ready to open IAS 12, which is an interesting package as well. So with that, I think I'll hand over to Theodore and some user perspectives.
Thank you, Karina. A few comments from the user side here. First on whether the impairment test can be more effective or not. Well, I partially agree with the board's view. However, from my point of view, I observe substantial variations that some companies, they tend to impairment test only in Q4. At least if you look back at accounts, it's a lot of more impairments in Q4 compared to the 3 other quarters during the year. While some others, they apparently have a more active view on their balance sheet values and book values throughout the year. And of course, seen from a user perspective, it's better with companies that have an active view on their book values throughout the year and not only look at goodwill in Q4. So that's my key comments on the first part here. When it comes to the discussion around impairment versus only amortization of goodwill, I must admit I'm a little bit charmed about the idea of not impairment testing, but consistently amortizing goodwill, just like we did, I think it was before 2004. A few reasons for that is number one is it's from a user perspective. If you amortize goodwill and not impairment test, then valuation across different companies probably will be easier, and it's easier to compare valuation multiples. For example, if you have a company that is created only by M&A, could have a lot of goodwill in the balance sheet versus an identical company, but it's generated through organic growth. They will definitely have different EPS, but should they have a different valuation for that reason? I'm not sure. And EPS is important for investors. Of course, you shouldn't overestimate the importance of EPS, because at the end of the day, it's the values and cash flow that drive stock prices. But I think it's definitely an advantage that EPS are comparable across companies. Second reason is that, and also which Karina alluded to, is that the only way that goodwill can be removed from balance sheets is through impairments. And when you impair an asset that of course is more or less a declaration of a failure. And I don't think that's a very good way to remove the impairment. So remove the goodwill. So there should be another way of reducing or removing goodwill from the balance sheet. And just third point I want to highlight is that, of course, there's some increased chance for inflated book values if you only impair goodwill and don't use amortization approach. So, and actually just one comment here that I thought of during today's presentation is that the issue around, and that's not mentioned on the slides, but that's the issue around impairment on technical goodwill, which I know is a confusing topic for some investors. And then over to point C on my slide here around the discussion of simplifying the impairment test. And I think I disagree slightly with the board's view here, in contrast to the A and B here. And I think at least when you have the discussion around a triggering event, it could be challenging to define what's actually a triggering event. For example, if you assume that you're in the industry where every year you reduce your price forecast for the goods you're selling by 5% per year. Is that a triggering event or not? Or when will it be a triggering event? So some example of that could of course be oil and gas industry. Slightly every year. Of course, now we're seeing that many of the big oil companies, they have reduced their oil price assumptions pretty substantially the past year. Of course, I think within telecom, we could see the same with the reduction in SMS prices, or maybe other industries where you see a conversion from subscription price based business model to more business models where you provide your services for free. So I think it could be very difficult to define the triggering event if you open up for a simplification of the impairment test. So that's all for me. Thank you.
Thank you all for those presentations. Before we continue, let me just remind the audience that they have the opportunity to raise questions. They can post questions, and they will be taken up by Morten when I have finished with the discussion with the panelists. So this topic is about many different questions, and some of them are highly technical in nature also. So I don't think we can come to the bottom of everything here. I think that we have heard different views about from all participants about whether we should have an indicator triggered test or whether we should have a system with an annual test. And also the question of whether we should allow post-tax cash flows and post-tax discounting. That is also different views about that, and they raise some highly technical questions that Kathrin also pointed to about deferred tax and things like that, what you do with that. So I suggest that we don't go further into that. Also, Morten mentioned now the question of impairment versus amortization, and that we take in the next chapter of this session. So we leave that for the moment. But I think that there are some questions that I retain that I would like to have the panelists' views about. It is the question of what is the correct level of the CGU which has been raised, whether it should be a segment level ceiling or whether it should be otherwise. And then we have the question of the role of, or how should we fight over-optimism in management over-optimism, and what is the role of auditors and regulators in that respect. And thirdly, I would like you to also to comment about whether this question about whether more disclosures about the cash flows assumptions are feasible and useful. So with that, I also, if you feel that you have already said enough about these questions, then I just urge you to be short about it. But let's start with Tim again. Please.
Thanks, Erlend. Yeah, I mean, on those issues, so the level of the CGU and guidance on allocation of goodwill to CGUs, and therefore the level you test at. Although the board didn't find a way of significantly improving the impairment test at a reasonable cost, I think the board is happy to hear some suggestions, and it's good that we've had some today, in fact, some suggestions of whether stakeholders think there are ways of improving the existing test, and certainly this might be one of those. I think in terms of this particular issue, I think in terms of the guidance, the question would be what particular aspects of IAS 36, what words in IAS 36 are difficult to apply, and where would guidance help, and so stakeholders' views on that would be really useful. In terms of over-optimism and the actual versus forecast cash flows, that's a potential suggestion for that. I think that's a good idea. I think the question that stakeholders would have to think about there is how long do you do that monitoring for, and then balancing the cost of doing that against the benefit that you might get from that. Obviously, you need to do it for a reasonable amount of time to get some idea of the forecasting accuracy, but there's a cost to that. And also, actually, the longer you do it, I would say that might affect the relevance as well, because if you're saying, my forecast 5 years ago I wasn't particularly good at forecasting 5 years ago, but management has changed or new processes have been put in place in that 5-year period, the relevant information might decline. So some thought about how that might operate in practice, I think, would be really useful for the board, because they're all good ideas in terms of how maybe the application of the current impairment test could be improved.
EFRAG, one of you, have you any comments?
Well, I think Kathrin has already illustrated the thoughts that we had in our draft comment letter. We are very much interested in understanding whether the directions of a possible review of the allocation guidance or the disclosures to mitigate over-optimism, how they are received by constituents before forming our final view. From the discussions and outreaches that so far, we have seen that they have been welcomed by many. Also the idea of having more disclosure to increase the transparency around the assumptions to mitigate the over-optimism. But we are very much in the listening mode on these proposals.
I'll be happy to add some comments on the level of the CGUs. I think an important difference is whether you have goodwill within a CGU, and if you find an impairment, a need for writing down that CGU, you start with writing down the goodwill first. And if you have goodwill allocated to a group of CGUs, which in a way means that you have to impair and write down other assets before you are able to have an impairment write down of the goodwill as such. So it's quite different how the mechanics work in many practical situations. So that is it's an interesting difference whether you have that goodwill allocated within a CGU and in a way can get rid of it if you want to, or if you have it at a group of CGU when it's much harder to get rid of that goodwill if you see that you have some challenges in that group of CGUs, but not so much that you are able to calculate an impairment and then can write it down. So that's one of the issues that would be good if the board could look into. On the issue of over-optimism, I think it's difficult to do something to that with standard setting or disclosure. That is an application issue in my mind. So I think it's important that it's treated as that, and that all assumptions that goes into all types of impairment tests are supposed to be reasonable, rational, supportable. And Goodwill tests are no different from other impairment tests in that way. And I don't think that significantly more disclosures will solve that issue. It will add a burden on companies on finding good ways of conveying the complexity in those often internally dependent assumptions. So how you can do that without writing really lengthy disclosures and burying the core of the information in a very long and complex disclosure note. I find that challenging. So I don't think that disclosures is the answer to that over-optimism issue.
Thank you all for those interesting insights. We just move on. So I leave the microphone to Morten for the polling questions and answers. Please, Morten.
Thank you, Erlend. And I would like to start off with a couple of questions on the improvement of the Goodwill impairment tests. And the first one I would like to pose is in regards to the disclosure requirement proposed by IASB, whether those proposals on the subsequent performance of an acquisition better help to identify triggers for a potential impairment of goodwill. And again, also repeat your opportunity to ask questions to the panelists if you have anyone. And I also here start to see on the question an early indicator, maybe on the more negative side, that either this disclosure is more for internal purpose or that the triggers we have currently is considered sufficient. But here we also see a change in polling coming, turning maybe the sentiment around, actually saying that yes, such requirements will help identifying triggering events. I will then also post a new question, and that's regard to the indicator-only approach. So hopefully soon the next poll should read, should the IASB adopt an indicator-only approach and then removing the requirement to perform an annual quantity test? So indicator only, or should we have the annual required tests? And then let's see the early indications of the response on the indicator-only approach. At least the preliminary question indicates a preference for having an indicator-only approach, as suggested by the IASB. Yes, and that seems to be the preference on that question. Then we will move on to a few more questions relating to the cash flows included in the value and use testing. So the two questions that will be asked to provide your comments on. The first one, would value and use estimates improve if cash flows from future uncommitted restructurings or enhancements to assets performance are included in the estimates? So that is one question. The other one is, would value and use estimates improve if post-tax cash flows and discount rates compared to only pre-tax inputs allowed currently? So 2 questions we want your response to now. Then I see at least on the improvement of cash flow by including uncommitted restructuring. The audience seems positive to that approach. And then maybe a more mixed picture on the doing the estimates on post-tax flow basis, even though still a majority can say approving the suggestion by the IASB. Yes, I think we leave the polling questions there and move back to the agenda. Just hold on 1 second. I got 1 question. We got hear from Theodore also about goodwill being wasting assets. So what has really been the investigation done to improve the amortization route rather than sticking with the impairment only? Has there been an assessment of on the amortization route to improve that one related to goodwill? And maybe, Tim, you can take a shot at that one.
Yeah, in fact, the next session actually talks about that particular issue, in fact. So should we just move back to the slide decks and I can talk about the board's considerations about reintroducing amortization and how it reached its preliminary review there?
Yes, Tim, yes, I suggest you do that. We just move on to the next session, and then you just keep in mind that question received and try to put in some answer to that when you present. Thank you.
Yeah, so if we can turn to slide 33, I think it is. Yeah, thanks. So in the post-implementation review, several stakeholders said that the IASB should reconsider amortization of goodwill. And since amortization provides a simple mechanism that does target the goodwill directly, the IASB explored whether amortization of goodwill should be reintroduced. And this slide lists some of the arguments for amortization and some of the arguments for the impairment-only approach that stakeholders put forward. And the discussion paper contains a fuller discussion of the arguments for both approaches. Firstly, just a point of clarification, when we're talking about the reintroduction of amortization, this would be with an impairment test as well. So those stakeholders in favour of amortization argue that the post-implementation review has demonstrated that the impairment test is not as rigorous as the IASB expected and does not provide as much information as the IASB expected, because the shielding carrying amounts of goodwill can be overstated, and so the test does not hold management to account. And they argue that an amortization expense in the income statement would hold management to account, reporting companies as profitable only if they generate enough profit to cover that expense. Some argue that goodwill is a wasting asset and amortization is the only way to show the consumption of that goodwill and to prevent internally generated goodwill being recognised in the place of acquired goodwill as it's consumed. Although it's hard to estimate the useful life of goodwill, some argue this is no harder to estimate than for other assets. And some argue that amortization takes pressure off the impairment test and ultimately reduces the cost of performing the test. On the other hand, stakeholders in favour of the impairment-only approach argue that the impairment test provides more useful information than an arbitrary amortization expense. Although often only confirmatory, they say it's still more useful than an amortization expense that most investors would ignore. And unexpected impairment losses do occur and can have a significant effect on the company's share price. They argue that the impairment test is working as expected. The objective of the impairment test is to ensure the combined carrying amount of the cash generating units containing goodwill are not higher than the combined recoverable amount. If applied well, the test meets that objective. Also, when developing IFRS 3, the IASB was aware of shielding, but concluded then that the test was rigorous. Some argue that goodwill is not a wasting asset with a determinable finite life. Companies acquire businesses with an expectation that the acquired goodwill is maintained indefinitely. And some argue that even if goodwill is amortized, an impairment test would still be required, and amortization would therefore not significantly reduce cost. So if we can move on to the next slide, please. The IASB's preliminary view that it should retain the impairment-only approach was by a narrow majority. The IASB was, like stakeholders, quite split on this topic. However, the preliminary view reflects the majority view that there's no compelling evidence changing back to an amortization model would be a significant improvement. Note, this isn't simply about which model is better, but whether there's compelling evidence that a change is needed. Given the narrow vote, IASB welcomes feedback on this topic from stakeholders. However, just repeating well-known arguments will not necessarily move the debate forward, and instead the IASB welcomes feedback that provides new evidence or arguments, or perhaps reasons why previous arguments are now more relevant. The IASB did consider two other approaches for accounting for goodwill earlier in the project, which is shown on slide 35. Thank you. And that's direct write-off and componentisation. On direct write-off, and this could be as an expense in profit or loss, in other comprehensive income, or as a direct write-off to equity, the IASB decided not to pursue this, as it would be inconsistent with the IASB's conclusion that goodwill is an asset, and with the economics of the transaction. The company's management believe they are paying for future economic benefits. And some investors also say that they prefer goodwill to remain on the balance sheet to help hold management to account for the amounts that they've spent on acquisitions. The IASB also considered whether goodwill should be separated into different components, for example, synergies or to going concern element and so on, and whether different accounting treatments could be applied to different components, reflecting the nature of that component. However, the IASB decided not to pursue this approach because it would, in their view, increase the complexity and subjectivity of the subsequent accounting for goodwill. And goodwill cannot be measured directly and has to be measured as a residual, and therefore the different components of goodwill could probably not be measured reliably either, there being many different items that might be captured in goodwill. And Karina actually mentioned it. I know, for example, in Norway, in the oil and gas industry, there's a lot of so-called technical goodwill that arises as a result of the recognition of deferred tax liabilities in the business combination. And some might say this goodwill should be separated from other components of goodwill and amortized or otherwise written off when the deferred tax liability is settled. And it'll be interesting to hear your views today on this topic. So I'll hand over now to Kathrin.
Yes, thank you. EFRAG has not formed a view and is seeking inputs from constituents. So as a basis for such discussion, the discussion paper could have discussed the unit of account when accounting for goodwill, including how the guidance of the conceptual framework for financial reporting for selecting the unit of account had been considered by the IASB. Normally, non-current assets are considered in different components, and it is acquired whether they include different components. And such discussion could have been useful to find out whether there are wasting parts included in goodwill and non-wasting parts, and to have appropriate accounting to those components. That would have been allowing to make a separate accounting decision based on this. And there should be a link between the information provided on when the entity is expected to benefit from the synergies and the amortization period of goodwill. So coming to the next slide, you can see that as EFRAG has not formed a view and EFRAG is seeking input from constituents and has, in relation to this question, raised several questions to constituents. There could be conceptual arguments for going into one direction or going into the other direction. I think it's a long-lasting discussion, and so beside these conceptual arguments, there could be practical arguments to going into the one or other direction. EFRAG has seen that there are different views depending on the jurisdiction, but even in jurisdictions, there are different views in which direction to go. Therefore, we really would appreciate what your thoughts are and why you would go into one or the other direction. Is it a conceptual reason or is it a practical solution? So any new evidence is one of the questions in relation to go into the one or the other direction. The other is goodwill considered being a wasting asset, or is it an accounting construct? And in relation to this, the question is raised, should goodwill be considered in different components where you identify a wasting part and a non-wasting part? And the question to the users is what happens to goodwill amortization when it is recognized in financial statements? Would such goodwill amortization be added back to the performance measures? Then another question would be, would it be helpful to disclose information about the age of goodwill? Because a goodwill that was recognized 20 or 30 years before might have a different information value compared to a goodwill that was recognized maybe 2 years ago for a new business model. And so the question is raised, would such information about age goodwill at information value? So now I hand back to you.
Karina, please.
Yes, thank you, Erlend. I find this part of the discussion really challenging. As I said in my previous session, I don't really know what goodwill is, and that means that it's really hard to find out what to do with it. It contains many different things. The business value is really the core of it, but it's not necessarily the major part of the amount that we calculate. It's other elements in there as well. You have the assembled workforce, which is possible to calculate and at least estimate. Some people struggle with the fact that it's not separately recognized, while our customer relationships are. It feels more close to us, the relationship by contract that we have to our employees than the uncontracted relationships that we have with our customers. So that's one of the aspects that we sometimes discuss. But then it's also all these valuation issues. You agree a price at one point in time, and then you negotiate some other technical aspects for another couple of weeks, and then you release, and then something happens to the share price. And if you pay with shares, that directly influences the recognized consideration for the acquisition as such. And if you have to wait a few months for regulatory approval of the acquisition, then many things can happen, in particular to the share consideration, but also to other valuation aspects in the transaction, until you actually recognize all the amounts in your balance sheet on the completion date. So what you negotiated and agreed on is not necessarily what you see in the financial statement. So that's also an aspect, and that also ends up in the goodwill amount, together with also the tax aspect, which we have been touching upon. So it's a complex thing, and in my mind it consists of several different things, and ideally we could have treated those separately. But do we have good enough information? Is it worth the additional complexity and effort? I really don't know whether that would be the case. I find that debatable, at least. Amortization. I struggle to find good conceptual basis for introducing amortization again. We don't know the amortization period. It's really hard to estimate an amortization period. But from a pragmatic point of view, it would be a way out of the balance sheet that isn't impairment. It would reflect that in the long run, I think most elements of goodwill are wasting. So sitting with a balance sheet where we have some elements of goodwill that came onto that balance sheet about 25 years ago, the link between that goodwill asset and the current business is quite weak. Technically, I think it's correct. I must say that. But from an economic point of view, much has happened to that business, and the goodwill as such doesn't have much information value. And I think we'll see more of that in the years to come as companies have a longer history with goodwill not being amortized, and as a result of that, naturally accumulating goodwill on the balance sheet. So I see challenges with all the discussed alternatives. I struggle to make up my mind of which is the best or worst alternative. But the fundamental problem for me is that I don't know what goodwill is, and that means that I really struggle to say what's the conceptually sound way to deal with it after recognition. And I fully agree that it should be recognized. It's something we've paid for, which means that writing it off immediately is sort of ignoring the problem, and that's not dealing with the problem. But we've been debating this issue for many, many years without finding sort of the really good solution. So I think that there are arguments for amortization, in my mind, mainly pragmatic arguments, and arguments for impairment-only model. But I struggle with the consequence that the only way out of a balance sheet is through an impairment loss, which screams failure. And there are issues with the impairment test that we have been discussing today. So I must admit that I don't have any good suggestions or clear suggestions to the way forward on this topic. So with that not very helpful comment, I hand on to the next panelists, Theodor.
Thank you, Carita. Well, unfortunately, it's almost the same conclusion from my side. On my previous slide, I also discussed like the issue with the impairment versus amortization, so I won't repeat too much of that. Just to mention that actually I have some sympathy for the alternative of going back to amortization of goodwill. When it comes to, there were raised a couple of questions here to users that I just wanted to address. That is not a part of my slide here, but the first one is whether users would add back goodwill amortization expenses when calculating performance measures. As a stock analyst, I think my answer would be probably not. We will not adjust EPS for amortization of goodwill, and I doubt that investors will do so either. So then the goodwill amortization will then be a part of recurring EPS. Meaning then that fair valuation multiples for companies after, if one introduce amortization of goodwill, valuation multiples would probably be higher for earnings multiples. Of course, one challenge here is the asset lifetime of goodwill. I definitely agree on Karina's view that it's hard to determine a fair lifetime on goodwill. Yeah, I don't have any clear answer to that. The second question that was asked to you users here that I made note of was whether or not if it would be useful for users to provide information about the age of goodwill. Yes, maybe, but frankly speaking, as a stock analyst, I'm not sure what I will use that information for, because often users, they have could have a similar part valuation of company, which is the basis for the view on the fundamental value of the company. And of course, in that respect, the age of goodwill would probably play a minor role. So of course, yes, more information is always useful as long as it's not information overload. But I'm actually not sure how I would deal with that information myself. Yeah, I think I'll leave it with that and pass on to Erlend. Thank you.
Thank you all for this. This is a big discussion, of course. I don't think it's necessary to ask the panelists to repeat what they would conclude if they were asked to conclude on the question of amortization versus impairment. I think we have not so very much time left. So what I suggest, I have noted a few things from the presentations that I would just take around on to ask whether you have you could comment. I have heard. Well, let me take the last thing, the question of age of goodwill, whether the age of goodwill, then I guess it's a question of whether one should have a disclosure about the age of goodwill in different groups, whether that would be useful and whether also that would be feasible, whether that would add very much complexity. Then the question of components of goodwill. So I read the draft such that one concludes that one is best to see goodwill as a whole and to treat it uniformly. So I guess the question of components would be that one picks out some parts that one knows more about and take a different treatment for that. Amortization probably. But I heard that Tim and also in the draft that they said that would add complexity, and so it will not be practical. Is that the general view of the panelists also? Then I heard Tim asked for views about the question of technical goodwill. I think that is very much tax related. But should there then be, because the next question would then be, should we have special rules about technical goodwill when we know that this will disappear with when the tax is once settled? Should we have special rules for that? And then also Karina mentioned in her last presentation and also this one, the question of whether it's useful to have a possibility to distinguish failures from consumption, if I can put it that way. Whether is it good to call everything impairments and write-downs, or should there be some more nuances in this? We have a few minutes left, so I ask you to be not too long. But Tim, can you start?
Yeah, I mean, on the age of goodwill disclosure, I mean, we'll see what people think on that and how feasible it is. So, I mean, the board will look at with interest on the feedback on that. On the components, I mean, I think what Karina said is quite telling in terms of I don't know what goodwill is, and therefore then to think that we can then reliably break goodwill down into its different components. And be able to measure those different components individually when we don't really know what goodwill is anyway, that would be the challenge, I think. So I think it will be interesting to see what stakeholders' views are on being able to do that. The board certainly thought it would make it more subjective and more complex, and didn't think you could reliably measure the components because goodwill is a residual of many different things, as Karina very eloquently described. Many things drop into goodwill. On technical goodwill, again, it'll be interesting to hear what people think on that. Are we just talking the deferred tax liability technical goodwill that arises? How do you define technical goodwill? Is it just a deferred tax liability, the sort of the opposite side of that? Is that reliably measurable, and how would you do that in practice? I think would be the things to think about there. And then on the final comment about the sort of negative connotations of impairment, I mean, obviously, if an impairment is recognised just simply because actually the benefits that are encapsulated in goodwill have been realised and converted into cash, and I can quite understand that's then not a negative impairment. That's actually a positive impairment because it's reflecting the fact that you've actually managed to capture the benefits that are in goodwill. I mean, obviously, one can disclose the reasons for the impairment, and you would obviously, in your disclosure, presumably then describe actually why that has happened. But the other thing I would say on that, and I fully understand the comment, the other thing I would say on that quite neatly sort of demonstrates that there's always seemingly an equal and opposite argument to any argument that's put forward for one side or the other, because on the other side, if you introduced amortization, some would then say investors can't then, or makes it harder for investors to distinguish between bad investments and good investments, and amortization might start to mask some of the impairments that are negative events. And so there always seems to be in this particular topic a sort of a polarised view, and there's always a sort of one argument for and then a sort of diametrically opposite argument against. So that's all I'd say on this.
Just one relatively short remark in the interest of time. I really noted that it is interesting to have a discussion what goodwill impairment is. Is to be seen as a failure of the investment, and if it is, then this would really go together with maybe making a distinction between such goodwill components that are wasting assets and such that are not. Then it would be helpful to say, okay, because this is wasting part of goodwill, then such information would not lead to the conclusion that this impairment or amortization is something that has to do with a failure of this acquisition. And I think I would give them back to you and maybe give the audience some more time to raise questions in our direction. Thank you.
Karina.
I can very shortly comment on the complexity issue that you asked about, Erlend. And I think that, yes, it clearly will increase complexity if we are to split goodwill into several components and treat them differently. I think the area where it's reasonably clear that it might be possible to do something that isn't very subjective is the tax issue. So that is the one that could be considered. on the other elements, I find it difficult to find good models for how to split goodwill into several components and treat them differently over time. Thank you.
Taylor.
Yes, thank you. One comment on like the technical goodwill, and of course I agree with Karin that it's difficult to split different types of goodwill from each other, except from technical goodwill. I think maybe we should have special rules for technical goodwill. That is definitely a recurring cost. It should be a part of depreciation or amortization. You know that technical goodwill will come down as the deferred tax liabilities is reduced, so maybe that should be called something different than impairments. Yeah, that's all for me.
Okay, thank you. Morten, I'll leave the floor to you.
Thank you, Erlend. And then we'll round off with a couple of polling questions related to goodwill, and also then lastly, the question with regards to should we reintroduce amortization of goodwill or keep the impairment-only approach. And then we start with getting a view on how you consider goodwill with regards to its nature and componentization. So you will be asked to respond on which of the following statements are you most identified with. And then A is with regards to goodwill is a wasting asset with a finite useful life. To the extent that the underlying asset is consumed, the goodwill should decrease. B, goodwill is an accounting construct. As it does not represent a real value, it should be gradually removed from the statement. C, goodwill is not a wasting asset, as it represents the synergies generated in acquisition and other intangibles that are not separated, and most of them relate to going concern assumption of the acquired business and are not consumed on a regular basis. D, goodwill represents a mix of elements, some of them wasting elements and some others not. The weighting of this mix depends on each single transaction. And E, none of the above. No major changes should be done at goodwill accounting at this stage. So, and then the final questions on the polling is, are you in favor of reintroducing of amortization of goodwill? And if you do so, is it for conceptual reasons? Is it for practical reasons? Are you against for conceptual reasons? Or are you against because there's no sufficient evidence that a major change is needed? And if you start to look at the preliminary views on the nature of goodwill, we see that I think as maybe Karina and others also alluded to, goodwill is on what is goodwill. It represents a mix of different elements. And that, of course, is making a correct reflections in the accounts difficult. And when question on reintroducing amortization of goodwill is starting to get in some question, at least it seems from the first respondents that a majority is leaning toward considering goodwill and wasting assets that need to be taken out of the balance sheet through amortization, but then more on the practical side than anything else. Then we also have got a couple of questions. So the first question, why not allowing impairment only for those committing to a meaningful impairment review for a considerable time into the future? And if no, to then have an amortization. So that was the one question. And we also have a second question. Isn't the elephant in the room that management that often has a short-term perspective, as long as the subsequent treatment of goodwill is different from identified intangible assets, will have a significant incentives to not to identify other intangible assets and have most of the excess value end up in goodwill. So that incentive there to, based on management incentives, to have most as goodwill. So anyone for the comments on either the polls or the questions? Tim?
Yeah, I mean, on the first question, I mean, I think the board is generally against providing options in terms of the sort of accounting treatments, and in this case would be someone would be selecting impairment only or amortization depending on their judgment. And I guess maybe I mean, we would have to understand a little bit more about how that would work in practice. But I mean, my main comment on that is that generally speaking, the board doesn't, tries to go away from allowing options in accounting because of the sort of comparability issues that creates. I mean, on the second question, I mean that sounds to me a little bit more of an application issue. I mean, but it is something that those stakeholders who talk about or support the reintroduction of amortization say that, well, if amortization of goodwill is reintroduced, that might sort of relax that tension slightly, because then obviously there isn't as much of an issue if some of those intangibles that have finite lives do remain in goodwill.
Well, if I may add from EFRAG perspective, I mean, it's interesting to see that 70% of the participants to this webinar would support the reintroduction of the amortization. I think it's interesting to know for us. But there is also a component of practicality in this preference, because if I see pulling question number 9, 30% consider that goodwill is a waste in assets, and 48% approximately think it's more a mixed of different components. So it's interesting to know the perspective that participants would be open to the amortization as a practical way forward. In terms of the elephant in the room and intangible, the incentive not to identify additional intangibles, I'm not sure we have enough evidence to state this to state so. For sure, we know that there are criticisms by the users also on the current accounting for intangibles. So also that approach of separate identification seems to at least deserve some more thoughts, and this is also something that the IASB is considering with one of the questions that they have in the discussion paper. To be fair on that specific point of the intangibles, we question in our letter why not discussing the comparison between internally generated and externally acquired intangibles, not in this step of the process, but in a project that we hope to see soon in the agenda.
Tim, you had a final comment?
Yeah, it was just now that I've had a chance to have a look at the polling question as well. Yeah, I mean, I think as with some strong support for the amortization, I think what the board, as I said, is looking for is whether there's compelling evidence for a change and whether that change would be a significant improvement to financial reporting. And I think the challenge for stakeholders, what the board would like stakeholders that have that view to explain is, as Theodore and Kathrin both said, it's probably not possible to reliably estimate the useful life of goodwill. Therefore, any amortization period, any amortization charge is going to be arbitrary. And that certainly was the board's view when it issued IFRS 3 as well. So is an arbitrary reduction in the goodwill balance a significant improvement to the model that we have today? And we certainly hear from some stakeholders who say that they think that if amortization is reintroduced, companies will just simply add that back in the earnings they report the market because they feel that it doesn't reflect necessarily the economics of their business, particularly if it is just an arbitrary reduction. And slightly contrary to what Theodore said, we do hear from a lot of investors that they say that they wouldn't find an amortization charge useful and therefore they would ignore it. So again, I think that what stakeholders who think that we should or the board should consider reintroducing amortization need to just think about is why do they think it will be a significant improvement to financial reporting moving to that model and providing the board with that feedback, which the board I think would welcome. Thanks.
Thank you, Tim. And I think end the Q&A session here and hand it back to Bjørn Einar for some closing remarks.
Yeah, thank you, Morten. I've really listened to this with interest, and I think everyone has contributed greatly to this session. As you may all know, the Norwegian economy is focused on oil and gas, energy-intensive industry, shipping, fish, farming, fisheries, and certain aspects of accounting typically are more familiar and prevalent, I guess, in our jurisdiction. I was challenged to take some takeaways from today's session, and just a few comments from my side. I note that Theodore and the analytics, they are really eager to get metrics and not just words on objectives. I think that's a fair comment, and that they really wanted to measure the skills of management, which is very aligned with the IASB's objectives. We also recognize that EFRAG has still very open views on both topic 2 and 3 today. And as, of course, Norwegian Accounting Standard Setting Body, the Technical Committee is also welcoming all comments from our constituents in order of forming our final comment letter. I noted also that producers argue strongly and very eloquently that it's hard to know what goodwill is, so it's hard to find conceptual, rational, logical rules for the correct and proper accounting. I think we all agree that there will be some kind of compromises, whatever solution we end up with. As a more less serious side of it, telling everyone about the age of goodwill is an interesting concept, and I wonder whether if it's like when goodwill become teenagers, they may leave the house, or whether it's more like when they come into a midlife crisis, they will be depreciated more easily or impaired, so it doesn't give the failure stamp on it. I think it was interesting to notice that some impairment losses would like to be relabeled as cash realization of goodwill instead of impairment loss. And I think that would benefit some readers and perhaps lower the threshold for taking a downward adjustment for the goodwill. And lastly, on the components, I think we heard more information today than actually is in the disclosure or in the discussion paper, which is, I think, we're too slim on this issue. There's a question of wasting and non-wasting components, especially for technical goodwill. But I think maybe we should also remind each other that it's also about how you allocate components. Some components of goodwill, typically technical, should never be lifted higher in a testing than to the CGU that it actually belongs, because it could be typically measured quite precisely and at a very low level where the tax actually is paid. But then, on behalf of the Technical Committee, and thank you, EFRAG, for organizing the practical side of this, and as we in the Norwegian Accounting Standard Body want to thank all the panelists for today's session. You all contribute greatly to an enlightening discussion, and I think we all gained some new understanding and insights. And please comment, please give our inputs to our body, and EFRAG will also welcome that, of course. And EFRAG also receives the Norwegian comments before they provide their final comments to the IASB. So with that, I thank you for today's session.
Thanks a lot.